Is there any real hope for a soft landing in the economy? Mortgage rates are sitting near 23-year highs. Bond yields are spiking to the highest levels that we've seen in 8 months. The US just lost their AAA rating as Fitch downgraded our debt, and home prices are jumping at the biggest rate we've seen since last November, all while wages are increasing and the unemployment rate is going down. So at the moment, we have a lot of mixed messages out there in the economy, which is leading half the people to believe that we're headed for a recession, while the other half believe that we can still see a soft landing. So in today's video, we're going to talk about what's happening in the economy with mortgage rates, with the Fed, with employment, as well as housing, so that you can put yourself in the best position if you're planning on buying a home anytime in the future. But before we do that, I'd like to take a minute and ask a favor. If you support the time and effort I put into these videos, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. Now, earlier when I said mixed messages in the economy, I meant mixed messages in the economy. This past week, we had ADP that private sector jobs had added 324,000 jobs, which was well above expectations. And at the same time, we had Japan dumping treasuries, which added additional volatility in the market. And with that, we saw the 2-year treasury hit 16-year highs after ADP jobs data shattered expectations. And on top of that, the 10-year climbed to highs that we haven't seen since last November. And then on the flip side, we got the non-farm payroll data that actually showed that job growth was slowing, coming in at 187,000 jobs versus the 200,000 expectation. And that should have been a bit more bond friendly, but on the flip side, we saw slightly higher wages and lower unemployment, which essentially pushed it back in the other direction. So we know that the job market is undergoing an immaculate cooling, but at the same time, there are definitely pockets of heat in the market, which is keeping job growth somewhat stable. And we saw that as jobless claims inched up to 227,000 jobs. But at the same time, we're not showing signs of raising US layoffs, as we actually saw job openings and layoffs decline in June, which is another positive sign for the jobs market, which is leading a lot of people, especially in my comments, to say that we might be headed back for that period of stagflation. So what is stagflation? Well, it's when inflation stays high and you have a slowing economy at the same time. And that's why you still have members of the Fed like Barkin saying that inflation is still too high. But here's the good news. We've actually seen inflation moderate, even on the Fed's preferred measure, which is the PCE. As we saw headline PCE moderate to 3%, which is more or less in line with the CPI numbers, which are also showing 3%. And the good news is we're finally starting to see shelter PCE moderate a little bit, which should ultimately lead to lower inflation over the next couple of months. But here's the thing. We're going to likely have some hiccups in inflation because of how they do the calculations year over year, especially when it comes to the CPI numbers. As next month's data, we're going to drop a 0.0 of inflation off. So even if inflation comes in at 0.2, that means you're going to see inflation actually tick up the other direction to 3.2. Now, you would think the Fed has already taken this into account, but I've actually thought that over the last couple of months, as I thought they would see that some of the data is lagging. Some of what they have done with regards to rate hikes take some time to set into the economy. But on the flip side, they haven't. They're only looking at the actual numbers, which means that if they see inflation go up and they're not taking those lagging indicators into account, you could see them continue to push further with the Fed funds rate. Now, at the moment, as you can see from this chart, interest rate traders aren't expecting the Fed to hike anymore this year. They're actually expecting a cut as of May of 2024. So with all of these mixed messages out there in the economy, it's really difficult to figure out whether or not we're going to have that hard landing, the recession, or be able to have a soft landing, no recession. Now, with all of this volatility in the market, we've seen mortgage demand for home buyers drop for the 3rd straight week as interest rates move back over 7%. And because of rising rates, along with rising home prices, or at least stable home prices in most markets, we've seen home ownership rates for households under 35 fall to 38.5%. And why is this important? Because 33 is essentially prime buying age. Historically speaking, that's when most Americans feel like it's the right time to become homeowners. And that's usually because they have some job stability, they're getting married, they're starting families, and they're looking for a stable place to call home. And here's the thing, demographics are still a key ingredient for the housing market, because not only do we have more and more millennials turning prime buying age, we have another another generation right behind them, which is almost equally as large, that will also want to become homeowners. And because of the persistently tight housing supply and the lack of new construction, you're going to have a really tough housing market for years to come. At the moment, you have Lawrence Yun, who is the National Association of Realtors chief economist, declaring that the U.S. housing recession is over. And you might be watching this video going, Jeb, he's the economist for the National Association of Realtors. Of course he's going to push housing because he wants his industry to do well. Well, I can understand that side of things, but also understand during the pandemic, Dr. Lawrence Yun was also telling everybody that the housing market was going to go gangbusters because of the lack of supply and super low interest rates. So he's not just a cheerleader for the housing market at the moment. He's been the one accurately telling you what's going to happen in the housing market for the last couple of years. And the reason he's saying that the housing recession is over is because we've seen existing home sales come back. We've seen pending home sales post their first increase since February. And that's primarily due to the tight inventory that we have out there in the market. If we had a lot more supply, we would have lower house prices because interest rates have moved up. But because we don't have that excess supply, if you will, the rise in rates hasn't really affected the housing market in a negative way. It's actually done the opposite and provided stability for prices. So if you're one of those people out there waiting to buy a house, waiting for foreclosures, waiting for homeowners to miss their payments because of the slowing economy, then I'd like you to consider that mortgage delinquencies fell to an all-time low in May. So there's less people delinquent on their mortgage than ever in history. So if you're considering buying a house in 2023 or maybe even 2024, I'd like to ask you to focus on the things that you can control, which are things like your credit, things like your down payment, things like your budget, figuring out how much you're actually comfortable paying per month. And more importantly, focusing on your emotions, not getting caught up, not being one of those people out there that says, I'm never going to be able to afford a house, when in all reality, anything is possible. You just need to have a plan and you need to focus on executing that plan. And as I've said before, there's nothing wrong with renting. I like to quote Dave Ramsey on this when he says, renting is buying you patience until you're ready to buy a home. But with that said, understand that rents aren't getting any less expensive out there. In fact, I found a chart that shows the 5 most expensive metros in the US as well as the 5 least expensive. And as you can see from this chart here, 3 of the 5 are located here in California, pushing almost $5,000 per month. So understand, if you're paying $5,000 a month in rent, that's $60,000 a year. That's $300,000 in 5 years, where you're paying someone else's mortgage. And maybe you're not in a position to buy right now, and that's okay. But you do need to focus on those things that I mentioned a moment ago. Now, at the same time, take a look at the 5 least expensive metros out there. Most of these are located in the South. The problem with the South at the moment is this is where a lot of the bigger funds, if you will, are looking to buy properties because they can pick up a house for $100,000, $200,000 and then in turn rent it back because the deal cash flows. And yes, this adds to the overall problem of inventory out there in the market. Unfortunately, there's not an easy solution. So while you have mixed messages in the economy, you also have housing issues that aren't easily solvable, which is why I believe home ownership is that important so that you can have some predictability to your future retirement, because 65% of Americans' net worth at retirement is parked in real estate. So it's okay if you don't own real estate, but you need to be doing something to put yourself in that same position at retirement. And with that said, if you're planning on buying a house anytime in the near future, again, focus on the things that I mentioned earlier, but also focus on having a longer term time horizon, having some money in the bank, and ultimately being comfortable with the monthly payment.